So in this session, we will basically talk a bit about the entire idea of how do you start your investment journey, and how do you basically begin that. This is not rocket science. This is fairly elementary. A lot of us already know this. Some of us may have just started working. Some of us may have had a couple of years of experience, but not too much. So the idea is to basically just sense and evaluate what kind of challenges people face, some common mistakes that a lot of people kind of make as they kind of start their investing journey, and in addition, looking at the current market scenario, and probably understanding whether it is a good time to kind of invest or not, right? So things on those fronts are what we are going to kind of cover. So as I said, some parts of these would be sort of elementary, but it just probably pays to add a little bit of impetus to some of those as we go along. So let's begin. Please note that this is not a recommendation to buy or sell any kind of securities. Data has been taken out from public sources, or basically research done at our end. But we do not recommend you to buy or sell anything. We are not advisors. It's a more an investment habit that we are trying to kind of inculcate in a lot of people at this point of time, right? Uh, what is the purpose of the session? Right now, a lot of the people, students specifically, when they start kind of their careers, uh, behaviorally and in a disciplined kind of a manner, don't start investing immediately. They kind of wait for a certain amount of time before they start investing. And our idea is to kind of build a good habit early through this particular session, right? The broad philosophy of investing, right, and saving in general, I think a lot of the people basically look at this as a sort of a budgeting exercise, where people believe they have a certain amount of income, and from that you remove your expenses, and then what you get is basically either your savings, and from your savings you could basically do some sort of investments. Right now, that's the broad sort of budget that everyone kind of builds in their sort of minds every time they kind of get some money. This is not a good way, specifically in the beginning years or formative years of your career, because it inherently depends on how much are your expenses. And make no mistake, we're all human beings. Once we get access to money that we are earning ourselves, we tend to spend it as soon as possible, right? Without even knowing it for a lot of time. So early in your career, it's probably just a good idea to reverse this equation, to put this here and take this here, however small that amount be, right? So you change the equation to income minus investments, right, is equal to expenses. Now, I'm not saying that you kind of don't spend money. All I'm saying is that whatever this amount be, it could be a small amount, it could be a large amount. But as a mindset, it is important to keep this in mind, that the first thing that happens is your saving. It could be with 500 bucks as you start, right? But this habit inculcating takes a lot of time, and you talk to anyone who has worked for 5, 7, 10, 15 years in the career, you'll realize almost all of them will go back and say, I wish I had started investing early, right? Almost everyone across the world would end up saying the same thing. So people keep making the same mistake again and again, and that's because nobody really guided them at the beginning part of their career to how you go about doing it. So that's the first part. That's the broad philosophy of investing, right? The second thing that is important, in addition to this, is keep in mind the fact that you need to sort of diversify. And when you diversify across sort of asset classes. You could have equities like stock markets. You could have bonds. Now, bonds exposure in India is not so easy. So you could do that either through debt funds or in other manners. Effectively your bank fixed deposits are kind of bonds that you can't trade, honestly, right? So have some exposure there. You could have sort of PF, PPF, EPF, etc. that kind of come under that. A little bit of exposure to gold. And initially in your career you can't do it because typically that's not a great idea to take a lot of loans and go and buy real estate. But I think in a country like India at this point of time, real estate probably doesn't make too much sense, broadly in terms of it being over bloated in a lot of the localities, and it probably is going to take a long sort of cycle to come out of that rut that has already been created. It's important to have money allocated across all of these, especially in times like these, because all it takes is about 5 weeks of market crack and all your equities portfolio goes for a toss. If you don't have anything in bonds, if you don't have anything elsewhere in liquid money, you can't really go and you take advantage of these situations that arise from time to time. So almost always it's an important idea to keep in mind that you need to be, however, lucrative the conditions are, however smart we believe we are, it's always a good idea to keep some ammunition available in the form of cash, right? Because then when the tide turns, that cash is basically what is supposed to be used to invest. How everyone who's in the markets today would wish that they would have more cash at this point of time that they could deploy at these levels on the markets. And make no mistake, markets could go lower, so you'll still feel the same after about another 5-10% dip in the market, that maybe if we had more cash we could have deployed here. It's always a good idea to keep this in mind that these specifically equity markets, once they turn, are going to move very quickly in either direction, right? So it's always good to kind of diversify yourself. It's in a way a very good lesson that a lot of us are getting right in the beginning of our careers, because a lot of the people who started post 2010 all the way up to till now did not get this lesson at all. For them, markets were basically you buy every dip that happens, right? And that's a important lesson that we need to learn, that when it turns it could get really ugly, and at that point we should have some assets available to purchase when things are not going in your direction. Some of the key myths that basically exist, I'm going to take this piece a little bit faster. People believe they can invest late and cover up. Obviously you can, but it becomes a difficult task. People believe equity is too risky. It is risky if you do it with sort of without preparation. you know Investing, like everything else in life, is all about being prepared to put in the hard yards, and then learning about stuff, and then going and finding a good investment opportunity. The worst thing that can happen is easy money getting made by people, because that sucks them into believing that it's an easy thing to do, and we're all kind of experts to do that. It's important to understand that you don't go on either extreme. There are two extremes. If you look at people around India in general, you either have people who just don't go to stock markets and say it's just too risky, or you have people who are only in stock markets and say, look, I don't like anything else, I'll only do equities. Both are extremes and don't need to happen. The third thing is we don't know where to invest, right? So there are solutions to this that exist, and we'll have to kind of talk about that as we go along in this. Quick understanding. If you look at basically an investment of 1 lakh every year growing at 15%, someone who started at the age of 25 versus someone who started at the age of 30, the blue line demarcates someone who started at 25, and the difference is staggering in terms of your final levels. It's almost twice the amount if you had started 5 years earlier with the same amount of saving, compounding at 15% each year. In fact, as we said, one of the early common myths that people have is that, okay, when I turn 30, I'll have enough savings. At that point, I'll start saving. So you could do that. Let's say you want approximately 2.5 crore at the end of your age of 50, right? So at that point, basically, you're looking at 2.5 crore approximately. If you start investing at the age of 25, you need 15% returns to achieve that goal. If you start doing the same at the age of 30, you need 21% annualized returns to be able to do that. Now, make no mistake, 21% is basically Warren Buffett-esque. There aren't too many people who would get that kind of a return over a 20-year period annualized. All you need is one bad year, and things go for a toss. So 12 to 15% long-term annualized is sort of a logical return expectation from an investor's perspective. You sometimes end up making more if you've done good kind of work and you've done good research, but remember, these are segments where you will require enormous amount of preparation to be able to reach that stage, right? some simple things that we can do is on a basic dedicated basis, start a little bit early. It makes life much easier for us. 15% generation is not, very, very difficult. I mean, it is difficult, but it's not very, very difficult. But 21% is almost impossible over a 20-year period, right? Whether we like it or not, all it takes is one of these 5 weeks that to come in between. And we don't even know what hit us essentially, right? How much investment would you need if you start investing at the age of, let's say, 40 and plan to retire at 60, right? And assume you want to build a career, corpus of 5 crore at your retirement. Now, depending on what age you are starting, you have certain years left to retirement. That's a small table that you can make in Excel yourself, right? And assuming you have these return expectations that are available in this, equities is the same as stocks. So you have these return expectations that are built in with a blended portfolio. If you are at the age of 25 and you want 5 crore at the end of your age of 35, 35 years of working, all you need to invest is 3,000 rupees to 13,000 rupees a month, depending on how you are kind of expecting your returns to come up. And that would basically take care of your corpus. Now, call it retirement corpus, call it money that you want to spend traveling around the world. As you kind of do that, call it money with which you want to fund further education, call it anything. I mean, I don't like using the term retirement because in today's day and age, nobody really retires. And, it's something that is too far in the future to really think about. But let's call this financial independence. If you want to be financially independent, it's extremely important that you start saving at least a small amount monthly to begin with, and then keep increasing it as you go along, right? When you do have more money, increase it. That's the idea, right? That's the first part of it. Now, why equities? Why would you want to invest in stock markets? Some people would believe, they really like equities. Some people would believe equities are tricky ball game. Remember, equities are nothing but stock markets, which is nothing but investing in a business. The only way you make money is by basically investing in equity. You can't make money using fixed deposits. You can't make money using cash. You can't make money giving out loans to people in the form of debt. You have to participate in the equities, right? In the business creation. Now, when you look at this, what you see on the screen is Asian Paints, right? This is what Asian Paints has done. The stock was probably about 100 here, or somewhere about that. And you look at a 10-year period and you look at what kind of returns, notwithstanding the recent correction, what kind of wealth has been created. And it's a standard company. We know about it. We probably, don't even need to worry about investing. You could just invest small amounts in this all at all periods of time. And this is not just a single company. There are n number of companies like this. So this is HDFC Bank. Again, notwithstanding the previous, the last couple of months. Even then, it was at 100 here and it's at 800 here. That's an 8x return, even after this entire sort of carnage that has happened in the recent past. So equities are a definite vehicle to create long-term wealth. The challenge with equities, especially if we are a young investor, is that if you have not spent enough time in the markets, it is very, very difficult to differentiate between what is a good stock and what is not a good stock. Right? It's in hindsight that we can talk about Asian Paints, HDFC Bank, Infosys, and all these companies. But for every HDFC Bank, you would also have something like a Yes Bank, right? And which was essentially, for example, touted as the next HDFC Bank. And nothing specific about Yes Bank. It's just that very few companies become HDFC Bank, right? So you could also lose enormous amount of wealth if you're not in the correct set of stocks at the correct point of time. And remember, when you dabble with stock markets, it's not a great idea to generally go and punt on random stocks because someone said it will go up. Don't go and look at stock markets from a standard first order impact that, okay, I believe this sector should do well and hence I should go and buy the stocks, because the stock markets are a combination of emotion. Lots of them in terms of, this is something called as HEG. There are a couple of companies, Graphite India and HEG. And the fun part is it kind of keeps doing this stuff, obviously on different scales that you see. So in 2016, the stock was at about $50. It went all the way up to $5,000 and now it's about $500. right? And you have lots of these which are there in the economy. You have Reliance Communication, you have Reliance Infra, you have Suzlon, you have almost all infra companies that were there in 2008 in India. You have Unitech. There are n number of examples of companies where if you don't pick the correct business, the loss of wealth could be enormous, right? So that's a standard challenge. Now we want to be in equities. We should be in equities because equities make good amount of money for us. But it's important to understand that there are certain limitations we get in when we are analyzing stocks. And what are those? We'll look at those as we go along, right? So what are the challenges, right? Picking the right business is difficult for us as laymen. I mean, it's easy to actually now go and say that, okay, HDFC Bank is your largest bank, so that should be good. But then it is not going to give you a 10 times return from here, right? What it has already done. So picking the right business today in order to be able to go and then say that, okay, 10 years down the line, this is going to be big, there's a fair bit of skill involved. And to be honest, there's a fair bit of, degree of luck involved. Good companies could just vanish in scenarios like what we are sitting today with, and you can't predict it. And financial services is actually one of the capital markets, or stock markets is an area which is extremely difficult because you just don't know what part of your return comes from skill and what part of your return comes from luck. Forget about analyzing someone else's performance. If you buy a stock today and it goes up tomorrow, you can't segregate clearly whether it was because of your skill or whether it was because of your luck. And that results in a lot of behavioral issues coming up. I'll talk about some later, but one of the key behavioral issues is when it goes up, you attribute it to your skill. But when the going goes against you, you buy a stock, it goes down, then you attribute it to bad luck. Markets were bad. And that's a wrong way to deal with things, right? It's important to understand that skill is paramount, but you will still require a degree of luck to be able to go through a business cycle. And sometimes companies can fold for no fault of theirs, right? We are in one such time as we speak. Lack of access to key information about the companies. Now, people compare thinking about, words like buy and hold, that you should go and buy a good company and never sell the stock. Two problems there. One, how do you define a good company if you go and buy a stock? So without enough preparation around it, it's a very difficult task to kind of go and do that. Two, you are not in the position that a Warren Buffett or Rakesh Jhunjhunwala are in, because they can actually call the companies on investor calls and ask certain questions which will, get the management to take note and go and do something about it. We can't do that, right? So that's the bigger problem that we face. We have lack of knowledge of market cycles as well. Make no mistake, about a year back, in fact, forget about a year back, about 3 or 4 months back, if you had asked people what is the maximum downside you could see in the Indian markets on any given day, that number would have been a small number. And even if you had asked people when Nifty was at 12,000, what is the max downside you see in the next 1 year, most people would actually have said 10%, right? We're off about 30% from there, more than that actually. And it's just amazing how market cycles teach us this from time to time. Capital markets and stock markets are a place where experience has no substitute. You have to be in the market once to experience it. And if you don't prepare for it well, the market is going to teach a very difficult lesson, right? A lot of the investors who started post 2016-17 are facing this trouble in the markets at this point of time because you just don't know what's happening with stocks. Where are they going? The final part is our day-to-day job may not give us enough time to be on a constant lookout for such opportunities. So how do you do that? And then behavioral issues, as I said, come up. Loss aversion. You buy a stock, it goes down, you don't sell it, right? Because you don't want to so you gamble on that. Basically, right? You'll say, maybe it'll go up someday, then I'll hold it to that point. You buy a stock, it goes up 15%, you try and make money, right? I mean, how many people would have actually held Asian Paints all this while? If you bought Asian Paints at 100, every day you would see the stock price and there would be an urge to sell it, correct? So it's behaviorally, it's very difficult to kind of hold this through these ups and downs. That creates a challenge, right? So what is the solution? Obviously, these challenges are there. Behavioral biases are there. Self-investing in stocks, if you are investing yourself, you need to learn properly about how to invest. It's absolutely imperative. You can read, you can invest time in yourself, you can go and look at different businesses. I'm not defining how do you learn properly before investing in direct stocks yourself, but it is important that you invest that effort and time in preparing yourself when you get confident about investing, right? Otherwise, self-investing is a tricky task. Even for seasoned guys, people get directions wrong, forget about target price. Getting the direction correct itself is a very big thing, right? And it's not you or me or anyone, seasoned. You switch on business news channels and you would realize people saying that stock markets are going to go up, and then you see that, they're going down. You see analysts who are changing target prices by 60% here or there. So it's not an easy task. And we must ask this question that if they are unable to do it, what is it that we will be able to do unless we have basically gone and read about it properly. From a pure investing perspective, it's a good idea to try this out with smaller amounts, because that kind of gives you a sense of, how do you go and invest in equities. But the simplest solution is to start investing in mutual funds to begin with, right? Again, not a recommendation that you go and buy a mutual fund today, but it's a good idea that whenever you start your investing journey, you start with mutual funds, any mutual fund. Right now, we keep thinking about, I want to invest in the best mutual fund. Investing regularly in a reasonable mutual fund is a better thing to do than investing irregularly in the best mutual funds. One, who defines what is the best mutual fund? That becomes difficult. You need to invest regularly rather than only lump sum investment, right? Don't try timing the market. You will always get opportunities like where we are today, and you could invest more amounts at this point, but start systematic investing, regular monthly investing, and keep following it through your career. There's no need to really stop it as such, right? Stay invested till you believe the story of the economy is over. Now, we are actually genuinely lucky to be in an economy that gives us this opportunity to play long term, right? Demographically, in terms of growth, in terms of what industries are growing, in terms of this being a democracy, in terms of this being a stable democracy. A lot of the other economies don't give that luxury to people, right? Economies are either too controlled, or they're too advanced, or too little advancement that is there. So from that perspective, we are essentially living in a time that is like a golden time of opportunities, and it's important that we take advantage of this, right? How do you select a mutual fund? So I'll just spend a couple of minutes trying to ascertain the mutual fund selection bit. There are a variety of things that you can focus on, right? The problem is we only focus on returns. Which fund has given a best return in the last few quarters or months? The problem with this approach is typically this is counterintuitive, right? So if you choose a fund based on near-term returns, it's counterintuitive. Why is it counterintuitive? Suppose a fund has given 100% return in the last 1 year, right? So the return goes to 100% in the last 1 year. Now, you know that on average, a fund is not going to be able to generate more than 20 odd percent annualized. If you select this here because it is the best performing fund, most likely you are going to see a decline in returns over the next few years before it picks up again. So in a way, short-term returns calculation for a fund is extremely counterintuitive. In fact, that's a bad way of selecting funds. So if you're looking at returns, you have to look at longer period returns to compare funds. And when I say longer period, it has to be 5 years kind of a number. Now, your investment horizon could be anything, but ideally you should be looking at 5 years. You need to understand what is risk adjusted return, right? So do a quick Google for Sharpe ratio. You can find it out. All mutual fund houses, if you go on a mutual fund website, you'll find a fact sheet there. All fund houses give a fact sheet which will have this. There are also mutual fund aggregating websites like Value Research Online or Morningstar, which will give you a Sharpe ratio for all the funds. So you could look at that. All things being equal, older a fund, better it is, because you would expect that the survivorship bias is kind of there in that sense that it has survived a few cycles. A lot of the funds don't make it through business cycles; they just close in between. So longer a fund, better it is. Keep that in mind. Longer duration that it has existed, better it is. Size of the fund is a double-edged sword. In a market like India, too small, and too small in a sense is, anything less than 1,000 crore assets under management. Too small creates a lot of pressure because small market dips and sudden redemption could create a lot of problems. How does that work? Think about it. I am a fund manager. I have 500 crore of assets under management. Market dips 20% suddenly in the last 2 weeks, right? That 500 crore becomes 400 crore. Now people start kind of asking money out. Big investors in this, let's say there's one big investor who has 30 crore in this. He will want to redeem. If he wants to redeem with such a small fund, I will have to kind of sell the stocks that are selling and may not be the stocks that I want to sell, right? Think about it. If I have Infosys and I have a small company, it is also possible that the small company I'm not able to sell today, because if I sell 30 crore worth of small company, that's going to kind of move the price itself. So I will end up selling something like Infosys just because I need to raise the cash. So that's a problem. Too big is also a problem. Why is that a problem? Let's say the fund size becomes 40,000 crore. Now, when you become 40,000 crore, the strategies become too static. Why? Is because, if you have to buy 2% of your fund into a stock, that's 800 crore. Now, you won't find enough companies in India where you can go and buy 800 crore worth of stock and not move the price of that, right? So you will end up becoming only a large cap oriented fund, which will only look at the largest companies, index companies that don't move too much. So essentially, in India, a sweet spot between funds would be somewhere in the range of probably, 1,000, 2,000 odd crore kind of AUM, going all the way up to 10,000 crore kind of AUM. You need to track the fund manager track record. Who's the fund manager? What has the fund manager done in the past? What has he or she done in terms of other funds that they've managed across organizations? Important, because at the end, you're giving your money not to the fund or the scheme, but to the fund manager. What is the theme of the portfolio? Is it true to its theme? Right? Is it trying to basically go ahead and say that, I am investing in special situations, but then is investing across all the large companies? There are funds that have done that in the past. So basically, the thing we need to understand is that if a fund manager says, I'm going to invest in the infrastructure theme, the fund manager should be investing in the infrastructure theme, right? There's a thin line here, and people cross that line sometimes. Cross in the sense, what is infrastructure? Can I say that Hindustan Unilever is also sort of infrastructure or not? Right. So sometimes that basically becomes a debatable question, and you will find infra funds having some investments in stocks that you can't really classify as, why should this be classified as infra? So be careful that whatever theme you're choosing well. And then you have expense ratios. These are kind of, maintained or in a sense regulated. So to that extent, you are fine. You do need to understand that when you're selecting mutual funds, there are two types of ways you can do that. You can invest in a direct manner where you go without an advisor or a distributor in between. You could go through the regular method where there isn't a distributor in between. There's some sort of a guy who will get some commission in between. Now that amount is only 1%. So, that's basically not very, very tricky in that sense. So I'll come to that separately. Just to reiterate on the theme of the portfolio thing, now this has become slightly better because SEBI has come up with a lot of regulations, but there have been historically times where the same fund house is running three different funds in the large cap space, large capitalization space. Now you got to ask the question, why are you running three different funds in the same kind of category? What is the real difference between these funds, right? And how does someone choose those funds, right? So it's important to keep in mind that if a fund says, if you're looking at debt funds and the debt fund is saying, I'm going to target shorter end of the interest rate curve, right? Yield curve, then they should be doing only that, right? If you are a debt fund which says, I'm going to get you sort of safety of principle, you can't go and invest in companies which are going to lose money not repaying your debt in that scenario. So it's important to categorize and understand that whatever, and every fund house in that fact sheet, when you go to a fund, there is an objective given for each of the fund. What is the fund trying to do? You need to kind of go through that and see whether, over a period, it actually is doing that or not doing that, right? Having said that, I understand that, we don't have enough data. A lot of the times we don't have time to do this. So focus on, some of the key things. You look at returns, but longer period returns like 5-year or 3-year returns. You look at age of the fund. You look at fund manager track record, and then don't try to find the best fund. A top, if you divide funds into quartiles, right? So this is the bottom 25%, and this is the top 25%. Honestly, anything in this is good. Honestly, anything is in the, in this is also fine. As long as you are in the top half of the funds, you are fine. You don't need to go and find the best fund manager in the country and the best fund in the country. That's not needed, right? Because it wouldn't remain the best fund after a while on whatever parameter you look at it. It is a mean reverting scenario. So that's something that you need to keep in mind while you are investing. Now, how do you buy mutual funds? You can use an advisor or a distributor. It's a good idea to have an advisor specifically in initial parts of your career so that you understand what's going on there. This is a regular plan where you are going to pay either a fee or a commission. If you go through a bank, for example, you will end up paying a commission. If you go through a wealth advisor, you will pay a fee to them. It is worthwhile because there is an intermediary involved, and this intermediary is going to kind of tell you what to do in the markets, especially in situations when you are not really on top of the game in terms of understanding what needs to be done in the market. It's important to identify who is a good advisor, but remember, advisor is a good advisor could be a really important part of an investing journey. How to find a good advisor is a tricky thing that I think you learn with time as you go along. If you want to do it yourself, you can actually go and visit any mutual fund website. They have a tab to invest online. All of them have, right? So you can just go to that and do that. They'll also have an app. You can also invest through a lot of online advisory sites, and there are lots of robo advisory guys like Grow, Kuvera, Investa, Paytm Money, Scriptbox. Some of them charge fees, some of them do it for free. You can just go and explore that. When you start investing, you need a one-time know your client, know your customer registration. Any of these websites or any of your banks will help you do that. And it's only one time, so you just need to do it once. So, you could approach an advisor or your bank initially for your first 5,000 rupees of investment. It's okay to pay a commission on that because all the other paperwork gets done through that. And then you can decide over a period of time if you want to go through the same route or you want to do it on your own. Usually there are benefits and disadvantages of both the approaches, so to each his own as you go along. But that I'll leave up to you. But this initial part requires some hand holding, so it might be a good idea to just go to a banker and say, okay, please do this for me, and they start that. Right now, the final question that is important for us is the time right right at this point of time. I mean, what's happening in the markets right now, and is it like a good time to invest? So nobody has an answer to that. What you see on the screen is the monthly chart of Nifty starting 1992, right? If you kind of divide this into two broad parts, right, you will see the first part between 90, and this is Nifty values created. Honestly, Nifty started in 94 only, so they're like sort of values created behind that. You had sort of a static period in between, and post 2003, we started our proper bull run. I wouldn't get into charting or technical analysis here, but you would evidently see that we had been in a channel all through that till about 2017-18. We got out of that channel. That channel started kind of acting as a point where we kind of kept revisiting the channel, but kept staying above it. Once we got back into the channel, we have gone all the way up to the midpoint and now are almost close to the, so if you're in the markets and you've heard those targets of 6,800 here or there, that's probably where they are coming from. So one part of that is there is a low here. Then you have other kind of targets that are kind of coming, which is a high here, that's 6,300. So these are typical levels that technical chartists kind of come and talk about. But you're still in a long term unless you break this, right? And to be honest, even if you break this intermittently, that's okay. This is a monthly chart, remember, so you have to spend a few months below those levels. We are still in a long-term secular bull economy, right? Which means the economy should do well. Now, make no mistake, the current crisis is a problem. It's not going to go away immediately. And that's something we're also going to discuss in another session at some point of time as to, what could be longer term impacts of this now. Some industries will just immediately revive. Some others may not. What happens on 15th April? If you open up everything, would you still go to a cinema hall on the 15th and watch a movie, even if it is started in the first place? Right? So there is a longer term impact of some of these, some of the things that are playing out around us, and certain sectors will suffer. But on the whole, you would still believe that once we are through this crisis, you should still be in an economy that, with a little bit of push from the government, should again go into an upward trajectory, right? It is never easy to identify if today is the right time to invest, which is precisely why it's a good idea to start and invest a little bit using mutual funds, because you don't see that every day. And if you do small amounts that are going over months or weeks, you don't really have just a simple behavioral trick. If you invest 5,000 rupees over 5 months, that's 25,000 rupees. If you invest 25,000 in one go, your likelihood of keeping looking at that 25,000 is much higher. So what ends up happening is, when the 25 becomes 30, 35, you get this urge to kind of book that money. That 5 never appears in your mind because you never realize that 5 has gone every month. So it's always a good time to figure out, and think about it. My understanding, and again, this is again to each his own. Don't treat my ideas as the correct ideas here. I don't see a reason why we should go below this, right? I mean, if it goes below this, then you are probably either talking about a massive problem on the health front, that's taking a bigger scare, in which case money would be the last of your concerns. But you know, all else being equal, if we are going to come out of this virus scare at some point of time in the next couple of months, whatever happens in near term notwithstanding, I can't see a reason why the markets would go dramatically below these levels. And if you're here today, then what is your downside versus what is your potential upside over the next 5 years, right? And investing is always a game of odds. You have to take that call. It is difficult to find. Now, again, the problem with investing in stocks without preparation is that you could go and buy a stock yesterday, and it could fall 20% today, and you're down 20% on your initial portfolio right away. So it's always a good idea to start with mutual funds. Probably start with index funds. Index funds are like a fund that is going to replicate the Nifty for you, because this is going to, you can actually buy Nifty ETFs as well, right? And these are things that are going to help you kind of build at least a base amount of portfolio that gives you a broad index exposure. Then as you get more confident, you can start getting into individual stocks. But this is a tricky time to try out your hand on stocks if you're not confident of how you're doing it, because you just don't know what is the limit on where the stock can go. And this idea that it has fallen so much it can't fall further, is, we all know what's happening around this idea across the markets, right? So it's imperative that we understand that I think the markets are significantly attractively valued than what they were here at this point. You have already gotten sort of a 33% kind of a lower valuation, that is, as compared to what was there at 12,000. What is important to understand is that in the short run, you could see more trauma coming out of this, and so you could see more downside to the markets. But it's a good time to start investing your initial amounts probably over the next year or so, as you build your skills. And I think it's probably not going to see a V-shaped recovery either. So it's going to give you a lot of time to sharpen your skills as you start doing stock investing. Now may not be the best time to try and pick stocks unless you have had some experience in doing that in the past, right? So that's broadly in terms of the markets. I think there's no right or wrong time to invest, as long as you are confident of the state of the economy and you're confident that this too shall pass in terms of the coronavirus crisis. I think these are decent levels to start investing. Could you see lower levels? Absolutely. Could you see more carnage in the markets? Absolutely. Nobody knows what's going to happen tomorrow and day after, and whenever the markets kind of are there. We don't know how the news is going to turn out. Probably that's going to be worrisome as well. But do remember that if you do think that everything will settle in the next 3 months and you're going to go back to the previous trajectory with some push from the government, some push from the RBI, then we are talking about, probably a 5-year, 7-year, 10-year investing cycle. And usually you don't get these dips unless there is something wrong with the economy in the near term. So now that we have gotten a dip, it probably is a good time to start investing, right? That doesn't mean you don't diversify. That doesn't mean you put all your money uh, in one shot. Don't do that. That also doesn't mean that you go randomly saying someone told me buy XYZ stock, so I bought XYZ stock, because that XYZ stock could go to zero in the next 3 months. We just don't know what will come out of this, right? So be careful around that. The market wouldn't go to zero. So that's something that you could probably bank on and play based on that, right? So that's in a nutshell. To quickly summarize, invest regularly, invest early, start investing early. Think of investing as an equation where as soon as you get some income to invest, start investing a little bit out of that into various asset classes. Keep some allocation to equities always, because long-term wealth gets created through equities. Do keep your portfolio a little bit diversified. Start with mutual funds, build expertise in stock investing, and over a period of time, increase your stock portfolio as you go along. Hope that kind of summarizes everything. So that's broadly it in our discussion today.